Now, chart patterns are well documented in technical analysis literature, are based on the psychological phenomena that occur between the buyers and sellers of financial instruments in liquid markets. Now, that was a mouthful, wasn't it? Pattern formations do not form a trading system, but rather provide an indication of the future trend of an asset as the prices break key psychological barriers in the form of support and resistance lines. That was another mouthful, but we're going to break it down. So I'm sure you have heard about chart patterns for online trading and their relation to technical analysis. You've probably heard about double tops and triple tops and head and shoulders and rectangles. But in order to have a complete understanding of chart pattern trading, we should gain a good understanding of one of the most common on-chart formations. What I'm referring to are triangle trading patterns. So in this webinar, we're going to discuss the basic triangle formation and what ways that we can properly identify and trade these patterns. Now, a triangle pattern is a specific figure formed on a price chart. Typically, identify when tops and bottoms of price action are moving towards each other like the sides of a triangle. So let me pop up some live charts and let's show you this, what it looks like in reality. So let me pop up my market structure chart. Now, on your screen, you're going to see what we call market structure or patterns. And these are all the typical patterns that appear in front of you in a trading period. We have double bottoms starting on the left, bull flags, bull pennants, ascending wedges, descending wedges, triple tops, bear flags, bear pennants, inverted head and shoulders, expanding wedge, and head and shoulders. And I'm telling you, I just saw one on somebody's chart analysis today on TradingView that they call the shoe and sock. I mean, some people make these things up, okay? But the fact is, the ones that we just talked about that are on the screen are the most respected and most well-known. Now, I don't consider double tops and triple bottoms as part of chart formation, and especially when you're short-term trading, because these appear quite often. Okay, I don't even pay that much attention to bear flags and bull flags. Now, pennants are quite popular, but I define a pennant as a triangle. I also see ascending wedges as triangles, descending wedges as triangles, expanding wedges, because they're all making some sort of a triangle formation. Now, the most popular of these that we're going to talk about is the ascending, symmetrical, and the descending triangle. Oops. Okay. But all the patterns I just told you, I classify into these. Now, what's the difference is when we have a wedge, okay, is in a symmetrical triangle, the two sides are at equal degrees. A wedge is formed when the two sides, the support and resistance lines, or the parts of the triangle, are on different angles. So it's still, to me, a triangle. Now, if you stop to think about this classification, now here is a textbook descending triangle. Absolutely beautiful formation. And here we have a beautiful symmetrical triangle, but they don't always form with the exact angles. So if you were to have this side on this angle and this side on a slightly different angle, that's still a wedge. You know, like I said, in my book, it's a triangle. So let's talk about, now that we've kind of lumped them all together, let's talk about why people call them by odd names and what they think they are. Because when the upper and the lower level of a triangle interact, traders expect an eventual breakout from that triangle. So what I'm saying is, forget the names. When you have prices pushing into the center of a wedge, of a pennant, of a triangle, it's got to break out. As such, many breakout traders use triangle formation to identify breakout entry points. Now, we can make it very complicated, and we can say some of them are biased bullish, some are bearish biased, but I've tested them, and we're going to talk about the bias doesn't ever work out. So we're only concerned with breakouts. So there are different kinds of triangles that can be seen on a price chart. Before you jump into triangle trading, you should understand the difference between the formations. So we will now look closer at the various triangle patterns and the corresponding trade setups. Once you are equipped with this knowledge, you should be able to trade a triangle strategy or add it to your setup arsenal. Now, as I mentioned, the basic of all basics is the symmetrical triangle. It's where the tops of the price action are lower and the bottoms are higher, as the two sides of the triangle are inclined with the same angle. This creates the symmetrical character of the triangle. Typically, with a symmetrical triangle pattern, the expected breakout is unknown. And to be honest with you, this is what I'm saying is all of these are unknown. The only thing that dictates what's going to happen is price action. So if you want to say, oh, I have a descending triangle and an uptrend, so it's going to break out upward, you're going to find you're wrong as much as you are right. So that's like guessing where I come from. So typically, with a symmetrical triangle, the expected breakout is unknown. The reason for this is that the bullish and the bearish move have equal strength as seen through the price action. When a breakout eventually occurs, it is likely to provoke a price move equal to the size of the pattern. Now, this is a standard calculation. Okay? It's not something I made up, and it is accepted in the marketplace that the breakout, and again, we don't know whether it's going to break out up or down, but the breakout momentum should carry it the equal distance between the beginning two legs of the triangle. Sometimes what happens is this leg might start back here, but until this leg forms, you don't have a triangle. If you measure the distance between the two legs when the triangle starts, you can use that to judge the potential breakout. And we use this for setting our target points, because you always have to set a target to figure out your risk reward ratio. But again, it's in the same either distance, because we have no idea which way it's going to break out. Now, as you see from the example, the potential target is based on the size of the triangle formation. With this type of measured move analysis, you will know what to expect from the symmetrical triangle breakouts, whether it breaks up or down. Now, the rule for ascending triangles is the same. Now, lots of people try to put a bias on ascending and descending triangles, saying an ascending triangle developing during an uptrend is a bullish move and predicting a bullish continuation. A descending triangle formed during a downward trend is a continuation pattern, and you should get a downward continuation. Not true. And I'm going to show you, I tested 700 different triangles, and I'm going to show you the results of what the bias is and how close they are to basically 50% each. So the difference between an ascending triangle and a descending triangle is not the trend line they come off of, not the trend, whether it's an upward or downward trend. An ascending triangle, the bottom of the triangle is moving up, where the top of the triangle is horizontal. So these types of triangles have one flat horizontal side and one sloping side, which is moving towards the flat horizontal side. The ascending and descending triangle patterns are mirror images of each other. They are identified as ascending or descending depending on the side on which the horizontal line develops. So if we had a horizontal line here with a slope, that would be a descending triangle. Now, this triangle pattern has an upper side flat and a lower side at an angle, or the lower side is ascending. In this matter, the tops of the triangle are on the same level and the bottoms are increasing. This type of triangle typically has a bullish character. Now remember, I've warned you about it, but it's in the standard definition. So when you spot this triangle on a chart, you should be prepared to catch a bullish price move equal to at least the size of the triangle. That's hogwash, and I'll show you. Now, granted, we should be ready to catch a breakout equal size of the distance. If we follow the rules that we should always trade with a trend, the only breakout that we really be interested is in one that comes off of the trend, and this would have come off of an uptrend, and we would only consider a buy or a long position in that case, but it doesn't mean that it has a bullish character. It doesn't mean that it's going to definitely break out up. And when you get yourself wrapped up in this bullish or bearish characters, what it tends to be is you tend to let yourself get sucked into false breakouts. So a descending triangle is exactly the opposite. Now, when the descending triangle is created during a bearish price tendency, we expect the trend to continue. It is very important to mention that the ascending and descending triangles sometimes break through the incline level, causing false signals and trapping some traders along the way. The same holds true for the horizontal price zone. You should always try to wait for the close of the candle to confirm the breakout. This will help reduce all the false signals. And we're going to get to that as we get down, after we get down to these, we're going to learn how to trade these. Pennants on the chart have similar shapes of that of a symmetrical triangle. They typically appear during trends and have a trend continuation character. That means they'll appear during a trend, and if the trend is up, they will have a character to continue in that direction. I don't care. You shouldn't care, because we're not going to blindly trade the character. We're going to see this pattern appear, and we're going to prepare to trade the breakout. So we have bearish pennants and bullish pennants. So again, here you can see on my little chart, here are all the major things that we see. We see symmetrical triangles, but we see rising wedges. We see symmetrical triangles again. We see bearish pennants, and we see increasing and expanding triangles, which are wedges on a separate angle. So again, the symmetrical triangle is identified by two discrete trend lines. The first trend line connects a series of lower up peaks, while the second trend line connects a series of higher troughs. Symmetrical triangles are generally formed during consolidation, and the volatility tends to decline. Now, this is what we're looking for in all triangles. As price moves into the apex, and this is the only thing I'm concerned with, is as price is moving into this apex, it's getting tighter and tighter. We should see volume declining and lower volatility as the price gets forced into here. That means all the traders on the sidelines waiting for something to happen. If volume isn't decreasing, okay, or it's staying fairly high or peaking up and down, we might want to think twice about what we see. Now, with a triangle, before we've decided to make any decisions, we can use this triangle to set our potential buy or sell points as well as our stop loss. So how can we trade from symmetrical triangles or triangles in general? Okay. Once a triangle is identified on the chart, traders will wait for a breakout either above the resistance trend line or below the support. That's it. Don't get involved in the bias. Don't kind of predict. After the breakout is confirmed with either a closed candle above resistance or below support, a stop loss could be placed approximately 10 pips below the last swing high low of the triangle or the last swing high. So what you want to do is look for the most recent candle inside the triangle, and if it's breaking out upward, we would use the low of that candle to set our stop loss. If it broke out downward, we would use the high of that last candle, that last swing high or the last swing low, to set our stop loss, and we would add 10 pips to that. So here we can see, let me get my marker back on here. Here we can see, in this case, we had a breakout upward. This breakout is what? Is equidistant to the width of the triangle. When we started and we got the breakout here, we could not confirm, and I believe in waiting for the third candle. First candle is your breakout. Second candle is your confirmation. We would set our entry point based on the low of the confirmation candle. And when that price was reached with the third candle, we would then enter the market. We would set our stop loss at 10 pips below the swing low. So here's our breakout. Here's our entry point. And we would wait. Now, lots of people will trade on a breakout candle, but a breakout candle is hard because you know what? It may look like it's broken out, but it ends up closing down back in here. So if you wait to try to trade that candle before it's closed, you don't know where it is. And then it could reverse right back into the inside the pattern. So I always believe, I'm very conservative. And so I teach and I believe that we should, and believe me, if you miss the trade, then you miss the trade. Okay, that's all it is, because there's always opportunities in the market. So here we have, and it doesn't matter that it's blue, it doesn't matter how long it is, we have the confirmation, the breakout candle. It broke out of the triangle as it moved to the apex. Whether it went all the way up to here or this was the close, doesn't make a difference. It broke out. Okay. The most important candle is your next candle, your confirmation candle. We would use that to confirm the breakout, because in a lot of cases you'll see it just returns back into the triangle. And when that candle closed, we would wait for that price, or we would set our entry point and enter it whenever that new candle touched that price. This way you have a confirmed breakout. Now there's a couple things you need to look at here, and we'll talk about them, but you want to look at volume, and we want to see where our support and resistance lines are. Because remember, before we can actually enter a trade, we have to confirm our risk-reward ratio. We have to look to see where our next support and resistance lines are, because even though we have a profit target up here, okay, and we have our stop loss here, if we had a strong resistance line here, okay, our profit target has to come down below that resistance line, even though it should go up there. Okay, we're going to hit resistance here. Okay. And what's that tell you? Don't make this trade. Because I'm looking for every reason to disqualify a trade. Okay. We have the exact opposite. Well, here we have an ascending triangle, but it doesn't matter about whether it's an ascending or descending. You'd set your stop loss and your take profit in the same manner. Now, the decision you have to make is, here we have an uptrend, a long-term uptrend, triangle formation, stop loss, buy point. Okay, that's a perfectly good trade, because you'd be buying in the direction of the trend. Because remember, the old adage is the trend is your friend. But if the breakout came here, okay, and you had the confirmation, would you trade against the trend? Not me. Now, if you notice here, what do we get here? See, earlier we got a breakout, but the second candle, the confirmation candle, moved back inside that triangle. You never got that third candle, so you could have never entered a trade here. You would have entered a little bit later here. Okay. Now, here's another example. Price is moving up, 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 up. Breakout. Okay. Confirmation. Trade. Stop loss. Limit. Okay. Beautiful trade. So let's go over and see what we have when we have them in our live charts. Now, this is a real live chart. This is a Bitcoin chart, a 1 hour chart. And here we have this beautiful candle formation. What did we get? We got confirmation. We got breakout, confirmation, third candle, entry point, stop loss here, target here. And see, we have the nearest support level. And this is, even though we would have used this width, and even though price made it there, we'd have to factor in this support zone, because look at all that congestion that we got at that support zone. Okay. Now, we would have had to calculate our risk-reward ratio based on this support level to see if we could afford to put our stop loss here and make that trade. So here on our descending triangle, we were actually thinking that the market would go up, and we were looking for a breakout this direction. But what happened is it pushed in the apex, breakout, confirmation, third candle confirmation. But we were coming off of an uptrend. Slight increase in volume, not much of an increase in volume here. Because in this case, you would have had to have been trading against the trend. And again, most traders don't want to trade on that side of the markets. They always want to trade with the trend. Okay, so in a descending triangle, same rules, same everything. An ascending triangle, same rules. Symmetrical triangle, wedge, all the same set of rules. Descending triangles are considered continuation patterns. Therefore, a break in support prompts the price to fall. The pattern is negated if the price breaks the downward sloping trend line. So how can we trade descending triangles? Same exact way. Typically, you want to buy after the pattern breaks its resistance, okay, as it did here in E. It's a good practice to set a stop loss just below the last significant high, 10 pips above the last significant high, enter down here. And in this case, we wouldn't have entered a trade yet because we have the breakout candle, but we don't have a confirmation candle and a third candle. Now here, again, but we had all three candles. But we had other rules that said we can't make this because it was against the overall trend. But on the other side, we could say this is now the downtrend and continue that way. It's your definition of how you're calling or defining a trend. But here was an absolutely beautiful scenario. And This is the thing. This is what you're looking for. When you have it, you can't have it perfect. Nothing in the market is ever just perfect. But that's why we have other sets of rules to help us make our decisions. But you need, the only rule you can't break is, well, there's a couple. Trade against the trend. And you need that third candle. You need the breakout candle, the confirmation candle, and then enter. Otherwise, you'll have too many mistakes and too many false trades and too many bad trades. And what we want to do is get them out of our heads. So the question is, how reliable are triangles? Well, to get an idea of this pattern's reliability, I've analyzed the charts of 5 currency pairs, and I've gone back over 10 years in the charts. On the 4-hour chart, I looked at 165 triangles, and I measured the slope using the simple moving average line. If the breakout after the triangle was up and the trend was up, this was classified as a correct bullish. When the breakout was down and the trend was down, this was classified as a correct bearish. Patterns where this wasn't a clear trend were just ignored. Now, if you notice, when I got my triangle and it was a clear bullish signal, bearish signal, 61.5% of the time it was correct. Well, that's not a bad margin. Correct bullish was 57.1, but that was only on a 4-hour chart and only on the Canadian dollar. For some reason, when we tested on the Japanese yen, only 33% right and 40%. On the pound, it was 52 to 57. The euro was 61 to 65. But these are just statistical overall breakout, rules. So it's got really nothing. There's nothing you can say that the currency caused it. But overall, when we put it all together, it came up with an average. Correct bearish trends only were 54% correct. That means 48% of the time it was incorrect. So would I want to say, okay, I'm just going to say that this triangle is going to be bearish and get ready and trade that breakout the second it's a bearish breakout without any confirmation? Now, so the odds are only 54%. I need better odds than that. Now, when we go to a 1-hour chart, where the market's moving a lot faster, we saw a slight shift. We fell down to 51%, 51.7% correct. Well, that's almost 50-50. So that means you're only guessing. So saying that it's a bearish or bullish characteristic and making that trade on the breakout based on its characteristic didn't get you so right. So if you say that I have to find out which way it's going to break and confirm that breakout and not get involved in bullish and bearish characters, you'll be better off. In this test, there was a total of 525 patterns on charts over the period investigated. The pattern was correct in predicting a continuation in just 52% of the case. Again, the bullish pattern had a slightly better odds of being correct. So even though the numbers are quite small, this does give some objective data on the reliability of symmetrical triangles across all the Forex pairs. Okay. Trading triangles can be very reliable because you'll see those results jump to 75% when you waited for the third candle. And that's what we want to do, is we want to move the odds in our favor. So when the pattern ends and the volatility dips to a minimum and then the support and resistance lines will be very close, the market will then usually start to show some preferred direction. There's no guarantee of this, however. As always, it's best to prepare for false breakouts and retests of the support and resistance lines. So the easiest way to trade this chart pattern is to treat it as a continuation breakout. Here, just wait for a clear break above the resistance line in a bullish trend, or wait for a clear break below the support line in a bearish trend. To do this, we use our support resistance indicators together with the triangle chart tool. Using the same settings, you can have the indicator and draw the support and resistance lines that extend from the pattern. While there are instances when a symmetrical triangle marks important trend reversals, they more often mark a continuation of the current trend. Regardless of the nature of the pattern, continuation or reversal, The direction of the next major move can only be determined after a valid breakout. So what do we want to do to increase your success rate? We want to look at the trend. In order to qualify as a continuation pattern, an established trend should exist. The symmetrical triangle marks the consolidation period before continuing after the breakout. We want to look at volume. Okay. As the triangle extends and the trading range contracts, volume should start to diminish. This refers to the quiet before the storm and the tightening consolidation before the breakout. Then breakout time frame. The ideal breakout point occurs 1/2 to 1/3 of the way through the pattern's development or the time span. The time span of the pattern can be measured from the apex, the convergence of the upper and the lower lines back to the beginning of the lower trend line. Breakout direction. The future direction of a breakout can only be determined after the break has occurred. Sounds obvious enough, but attempting to guess the direction of the breakout can be very dangerous. Even though a continuation pattern is supposed to break out in the direction of the long-term trend, this is not always the case. A break should be a closing basis for it to be considered valid. So that's what I'm saying is, number one, when we have the break, you have to, if you try to say that's a breakout candle, before that candle is finished forming, it can end up back inside and never, you have a high all the way up there, but the candle body ends up inside the triangle. Some traders apply a price or time filter to confirm validity. Breakout above, second candle, confirmation, third candle, trade. Those are my rules. Now, after a breakout up or down, the apex can turn into future support or resistance. The price sometimes returns to the apex or support and resistance level around the breakout before resuming in the direction of the breakout. Price targets. There are two methods to estimate the extent of the move of a breakout. First, the widest distances of the triangle can be measured and applied to the breakout. Second, a trend line can be drawn parallel to the pattern's trend line that slopes up or down in the direction of the break. The extension of this line will mark the potential breakout target. But again, you have to take in consideration that a major support or resistance line level will stop and makes you reevaluate that target point. In some, triangle patterns are easy to spot and provide good risk-reward opportunities. Traders can quickly know that a big move may be near, as well as the profit objectives and the amount to be put at risk. Now, the triangle will help us always set our stop loss, our entry points, our target, and our risk-reward ratios. So now that you have the knowledge of these powerful price patterns, you are a step closer to becoming a much more confident, experienced trader. And you test it. Don't go out and trade it right away. Do it on a demo platform. Try it out. You'll find that this is a nice, easy trading system. Okay. Most of your definition or most of your potentials will be broken by your risk-reward ratio, so that means you can't make it. If they aren't, then you need that third confirmation candle. A lot of them don't ever make that third confirmation candle, and they're disqualified. Now, when you have all of that in place, volume increasing, targets, support and resistance levels, third candle breakout confirmation, risk-reward ratio, go make the trade. So on that note, I'm going to say thank you very much for joining us. Have a great night, and we'll talk to you again. If you have any questions, go to www.avatrade.com, and someone will be glad to help you on their chat, their support, or sign up for their education, and you can talk to a financial educator on one-to-one. Thank you very much, and have a great trading night. Bye now.